Hello guys, welcome to the Highway Investing channel. What if I told you that you can get paid to buy stocks? Before you say, "No, that's impossible. This must be a clickbait." Dislike. Relax, take a deep breath, and listen to me for the next few minutes, and I am sure I won't disappoint you guys. In order to know how you can get paid to buy stocks, you should first know how options work. Since the intention of this video is to let you know how you can get paid to buy stocks and not explain how options work, I will not go in depth on how options work, but rather give you a very quick overview of how a put option works, as getting paid mostly revolves around selling put options. I have linked 2 videos in the description, which explains the concept of options in depth. I suggest you watch them before watching this video. Now, for those who are familiar with options, I would quickly breeze through how put options work. A put option contract has 4 parts to it: the underlying stock on which it's based, strike price, expiration date, and the price of the option contract itself. One important thing to keep in mind is, one option contract represents 100 shares of the underlying stock. Let us look at an example. In this put option contract, the underlying stock is Tesla. Strike price is $1,000. Expiration date is November 20th of this year. The price to buy or sell one quantity of this contract is $5,000, as one contract controls 100 shares. The buyer of this put option contract holds the right to sell 100 shares of Tesla at the strike price of $1,000, on or before November 20th, if the stock is trading at or below $1,000. And, similarly, the seller of the put option is obligated to buy 100 shares of Tesla at the strike price $1,000, if Tesla ends up being at or below $1,000, on or before November 20th. I hope this gives you a quick refresher of how a put option works. Now, coming back to our question of how to make money while buying stocks. Let us say you have decided to buy Tesla stock at the current price. Good old way of buying is to use a limit order to buy Tesla at the price that it's currently trading at. Or the smart way is, you can go and sell put options on the Tesla stock. For the sake of explanation, let us say you sell one quantity of this option contract. By doing so, now you control 100 shares of Tesla. Now there can be 3 different possibilities after selling the contract. First, let us say Tesla stock doesn't come anywhere near to $1,000, on or before 20th November, at which point you are not obligated to buy the stock, but get to keep the initial premium of $5,000, which you got by selling the option contract. Second possibility is, let us say Tesla stock shot up to $2,000, much before the contract's expiration date. Now, since the probability of Tesla coming down to $1,000 has decreased, the option contract loses its value. Now you can buy back the contract that you had sold earlier, at a much lower price, and pocket the price difference as profit. Third and final possibility, Tesla stock falls below $1,000 and goes to $900 and stays there until November 20th. Now the buyer of your option contract would force you to buy 100 shares of Tesla at $1,000, and you get to keep the initial premium of $5,000 which you got by selling the option contract. Now your average cost basis of owning 100 shares of Tesla is $950, and not $1,000. In all of the 3 possibilities, you end up in a better place than you would have if you had bought the shares directly. So, should you always sell put options when you plan to buy stocks? Well, that depends. Let me tell you when it makes sense to just buy stocks directly rather than selling put options. When the price of a particular stock is down so much that you don't want to miss that opportunity. If that's the case, I would suggest go buy the stock directly and don't waste time selling put options. If you don't plan to buy a minimum of 100 shares of a particular stock. Let's say you want to hold 15 shares of Tesla in your portfolio and don't intend to spend a fortune on buying 100 Tesla stock, then selling put options doesn't make sense. Instead, you should be buying 15 shares directly. Now, when should you be selling put options rather than buying the stock directly? You intend to buy or have enough funds to buy 100 shares of a particular stock. This is a very important requirement to sell put options and is the base for the next scenarios. You like a particular stock, but in your opinion the stock is slightly overvalued, then sell put options at the strike price you would be comfortable buying the stock. You like the stock and also the current price of the stock is attractive but you aren't sure of owning it. If that's you, then you could be a seller of put options, that way you end up making a little extra either way. Let me know what you guys think in the comments section. Which one would you prefer and why? Please like, share and subscribe, and have a nice day.